Hey, good afternoon, everybody. Uneducated economist here. So let me ask you guys something. You familiar with hedge funds? So I got this out of Barclay Hedge, and I just kind of wanted to read you a couple of paragraphs out of here. It says, hedge funds can invest in wide range of securities other than mutual funds can. While many hedge funds do invest in traditional securities such as stocks, bonds, commodities, and real estate, they are best known for using more sophisticated and risky investment techniques. Goes on, hedge funds typically use long-short strategies, which invest in some balance of long positions, which means they buy stocks, and short positions, which means they sell stocks with borrowed money, then buy them back later when the price has fallen, ideally fallen. Additionally, many hedge funds invest in derivatives, which are contracts to buy or sell another security at a specified price. You may have heard of futures and options. These are considered derivatives. Many hedge funds also use an investment technique called leverage, which is essentially investing with borrowed money. Strategy that could signify increased return potential, but also creates a greater risk of loss. In fact, that name hedge fund is derived from the fact that the hedge funds often seek to increase gains and offset losses by hedging their investments using a variety of sophisticated methods, including leverage. Hedge funds are typically not as liquid as mutual funds, meaning it is more difficult to sell your shares. Mutual funds have a per share price called a net asset value. This is calculated each day, so you could sell your shares at any time. Most hedge funds, in contrast, seek to generate returns over a specified period of time called a lockup period, during which investors cannot sell their shares. Private equity funds, which are similar to hedge funds, are even more illiquid. They tend to invest in startup companies, so investors can be locked in for years. And the reason why I brought that up is because I came across this article out of the New York Post today. It's titled, "Major Hedge Funds Are Scrambling to Prevent Financial Wipeout." It's dated December 16th, 2018. And what I found in here was quite interesting. Now, normally I can kind of like go through and kind of break down Fed speak pretty good, but sometimes they just say stuff and they are not being clear at all, and they don't even have any intentions on being clear. Like this quote right here says, some sectors of the some sectors of the fund industry are crowded and competing with other investment vehicles. I don't know what that means. I don't know what investments he's talking about, why they're crowded, I don't know what that means, right? And then he goes on to say that alone should cause the number of closures to increase as bad managers get fired and money is recirculated into the managers that do better. Well, yeah, that's pretty typical. I mean, if you're underperforming, then they got to, take away what you're doing and give it to somebody who is performing. I mean, that only makes sense. But again, it doesn't specify on what investments or why why they're not doing well. But it goes on to say here, although there are still more launches than failures, as new money was infused into the hedge funds in the first half of 2018, nervous investors have pulled $10.1 billion from hedge funds through October, according to eInvestments. And it goes on to say, we remain bearish, right? This is coming out of the chief investment strategist for Merrill Lynch. He says, we remain bearish as investors' positioning does not yet signal the big low in asset markets. Right? So these hedge funds and stuff like that, they are worried and they are not doing so well. Apparently, they have over leveraged, and some of their managers are like losing money hand over fist right now, and they are getting fired. They even talked in one company here of 125 after losses with withdrawals and are eliminated, right? That's how many job cuts there were done. After losing and withdrawals eliminated $4 billion in assets from that company, they had to fire 125 people. Makes sense. And then each day brings more depressing news. So most recently, hedge funds closures, including Brenham, Brenner, Turlbillion, Highfields, and Criterion. Anyway, I never heard of these companies, but anyway, all those people have recently closed. And I like how it goes in here, and all those hedge funds in this story had no comment. So yeah, hedge funds are in crisis right now. Apparently they have made a bunch of really bad bets. They have over leveraged themselves. People are getting fired left and right, and they're in turmoil. So keep your eye on hedge funds. Look for those news stories out there, and maybe somebody out there, one of our listeners out there, can maybe explain a little bit more about into hedge funds and what's going on and how come they're losing so much money right now. All right, this thought that it was an interesting article, and I'd bring that to you today. And I also wanted to tell you that there's a bunch of news coming out today. So a bunch of like the home builders sentiment is coming out today, which I think was already out. I'm going to go read the articles on that here in just a minute. And then what else is coming out? Oh, the Fed fund rate. The Fed fund rate is going to be announced here either later today or tomorrow. I can't remember. But anyway, those are two big things. So as soon as I get the information on those, I'm going to put videos out about those as well. So anyway, yeah, go take a look at hedge funds. Read the news on some of that. It looks like those guys are in crisis mode right now. Uneducated economist. Talk to you guys later.